Hey folks, Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. Up on the screen, I have the 10-year note versus the 2-year note, the spread between those two instruments. Why? Because we had the Fed this week, right? Fed came, first rate hike in 3 years. And within their speech and the press conference, as well as their statement, the dot plot, which is a forecasting of rate hikes, talked about a rate hike every month for the rest of the year, every meeting. So there's 6 more they're talking about. And there is a desire, a plan to reduce the balance sheet in the months ahead. The big takeaway is they said that the economy is strong enough to support the 6 rate hikes. Now, as a mortgage professional, what you have to share with your borrowers, your clients, your partner network, your builders, what we're watching for is the economy strong enough to absorb those kind of rate hikes. Within their communication, they actually released a summary of economic projections, and they have ratcheted down their growth prospects for 2022 pretty significant, from over 4% to now 2.8%. Folks, at 2.8%, there's no room for a bad policy move by the Fed. So I think the Fed, in their words, said, this is a plan. We want to do this. We want to hike rates. We want to do this, but we will need to be nimble. And we're here to tell you, we think they're going to have to be nimble because we're not sure that the economy can support it. Something will have to materially change, and we'd have to probably see a significant decline in oil prices that's sustained. Otherwise, that's going to continue to weigh on the psyche of the consumer. But what I have up here again is a 2-year note and a 10-year note spread. I'm going to go over here. 2018, December. We talked about December 2018 looking a lot like 2022, right? Fed wants to hike rates a bunch of times, shrink the balance sheet. Back in December of that year, they hiked rates for a 4th time, and mortgage rates from that time did nothing but improve. They improved dramatically in December 18, even though the Fed hiked rates a 4th time. Why? Because basically the bond market told the Fed, you got it wrong. You're overdoing it. And then the Fed spent the next year lowering the Fed funds rate. They actually had to cut, and they actually had to start buying bonds. So here we are again, and at the same spot, and we're supposed to be led to believe when we were in a much different and stronger economy in 2018. We had consumer sentiment at 20-year highs then. We are now seeing consumer sentiment at 10-year lows, recessionary levels. We've had this level of the consumer sentiment be in a recession. That's how bad people feel. And then the oil is part and parcel of it. So we're led to believe that right now, the economy can absorb 6 rate hikes without this yield spread going beneath this level. Boy, that's going to be a tall glass of water. We shall see. It will be a fascinating and tough, challenging year as a mortgage professional, because now we have to react to all these data points: the jobs report, ADP, of course, CPI and PCE, multiple inflation figures. So we're going to have to deal with all this stuff. And every time these reports come out, it will create a ton of volatility. But the good news is for us is that the bond market is telling us something. You know, on the Fed meeting, in the middle of the statement coming out and before the press conference, yields ticked up, hit about 225 in a 10-year note. They have since backed off, and we've improved a little bit, closer to 215. That's a good sign. And as a mortgage professional, you have to like how the bond market's behaving. You can't sleep on it, because if in 2018, if they only hiked rates a couple of times, the market absorbed it. But then they did that 4th one, and that's when mortgage rates improved dramatically, literally on the 4th rate hike. We only have 1. At MMG, we don't think they can go 7 times this year. They may try. We'll see. I doubt it. So that does mean if they're able to increase a couple times, that maybe rates go up a little bit. But the bond market is telling us something at 215 on a 10-year note. It's certainly not worried about runaway inflation. Otherwise, a 10-year note would be much higher. So we have that to deal with. I think it's a great backdrop going for this year. The housing demand remains incredibly strong, and mortgage rates, have already backed up. And right as the Fed hike rates, it looks like we're seeing a little bit of improvement. Let's hope it continues. Have yourself a great weekend. Be safe, and we'll talk to you soon, folks. Bye for now.